Dariusz Kowalczyk, the Chief Investment Strategist at SJS Markets. Dariusz, Happy New Year. Thank you very much for being with us here on Worldwide Exchange.
Happy New Year. My pleasure.
For the first day of the new year, we had a really good start. Somewhat mixed in Asia, but you think spring would be a good time for equity markets, but you're warning perhaps somewhere down the road a sharp correction might take place. Explain your case to us.
My strategy revolves around outlook for global economy, which equity markets usually anticipate with about 2 quarters of time lag. So given the fact that we are still in a process of recovering from the crisis, global growth is accelerating, equity markets continue and will continue to move higher because investors are predicting that profitability will increase and this is boosting valuations. However, the outlook for the global economy towards the end of this year and in the beginning of 2011 is not that good because expiry of fiscal stimulus measures will most likely bring a double dip, and equity markets will begin to fear that and anticipate such outlook around the spring, which is when a major correction, I believe, will start.
Here in Asia, a lot of focus seems to be on China after that strong manufacturing data, lots of concerns about possible rate hikes. Now, you're willing to bet something is going to happen in the second quarter. Why that time frame?
Chinese economic growth will continue to accelerate and will peak in the second quarter. I think in year-on-year terms, GDP may expand even around 13 or 14%, given the very weak base effect from last year. At the same time, Chinese inflation will begin to move higher towards the end of the first quarter and will definitely be somewhere between 3 and 4% in the second quarter, bringing real interest rates to very low levels. And this is bound to push the PBOC to begin gradual tightening and first increasing the reserve requirements ratio, subsequently moving somewhat higher on the official lending rates.
Dariusz, it's Bertha here in the U.S. So looking at this scenario with perhaps China tightening, perhaps the U.S. moving to tighten more quickly, you say there will be a double dip. So where do we go then if we believe there will be a double dip? Where is it likely to be the worst?
I think that the economies where the slowdown will be the most severe are the ones that are accelerating very fast right now. So we are looking here at countries such as China, which, like I mentioned, will see double-digit growth in the first half of this year, or the U.S., where economic expansion in Q4 will be about 6% quarter-on-quarter annualized, 5% in the first quarter, so very fast. And then when fiscal stimulus packages in those two countries wane, the slowdown in both may be very dramatic unless policymakers come up with another wave of fiscal stimulus packages, which I think is what's going to happen because it will be politically unacceptable to see a major correction in growth rates. But even that the second wave of fiscal stimulus will not prevent a double dip. It will just make it less dramatic.
Dariusz, good to see you. With all that said and done then, where do we put our money in the first half of the year, i.e. a period when we're not sure about the evidence definitely for double dip or otherwise? Where do we put our money for our viewers to make money?
In the first quarter and possibly into the second quarter, I'm quite confident that risky assets will continue to be relatively safe, if I may say so, bets, because when global growth is accelerating and the central banks at the same time are not yet tightening, especially the major G3 central banks, liquidity will be abundant and will tempt investors to continue the carry trades. So there will be a lot of borrowing the dollars, the yen, selling them to buy riskier assets, and equities, commodities, corporate credit, emerging market assets are all going to see solid gains. In terms of the equity markets, I'm betting that China is likely to be one of the top performers through the spring because it's one of those markets that have recovered the least in terms of the percentage of crisis losses that have been retraced, only about a third. In terms of currencies, well, the trade currencies, the Aussie dollar and the Kiwi dollar, I think we will be celebrating the parity in terms of Aussie dollar, and those are the bets that are likely to be the biggest winners.
Dariusz, thank you so much. Thanks for starting off the year with us. We appreciate it. Dariusz Kowalczyk, the Chief Investment Strategist at SJS Markets.
My pleasure.
So now let's get you the big stories that we're following from around the world on this.
Strategist SJS Markets Limited. He's been with us for the last hour. So Dariusz, you know, if the dollar continues to weaken, how will that impact your investment strategy?
I think under such scenario, you would have to assume that flows are continuing out of the greenback because it is the cheapest funding currency and will remain so for several months at least. And they would be moving to emerging markets, given that growth outlook here is the strongest. So you definitely have to be long emerging market assets, especially in countries with the fastest potential for expansion, such as China and India. But it will also be favorable for commodities. And I think that oil, for instance, by the spring, will be trading between 90 and 95, and gold will revisit 1,200 levels again.
All right, 1,200 levels. We'll keep that in mind. Dariusz, thank you very much for starting off the new year with us. It's always good to have you on the show.
My pleasure.
Dariusz Kowalczyk, Chief Investment Strategist, SJS Markets Limited. Well, coming up next on Worldwide Exchange, we'll get back out to Dubai to